name's Sharla Dandy and I'm from McGill's Chartered Accountants. I am one of 3 partners at the practice, and we have 3 offices, one in Cirencester, one in Malmesbury and one in Fairford. So basically, I'm going to talk about the difference between a limited company and a sole trader partnership. And I'm also going to talk about some of the other key questions we tend to get asked about, which is around VAT, research and development, CARs, and the most optimal way of extracting profit. So with the sole traders and partnerships, the relevant tax, therefore, is income tax. So you calculate the profit on the accounts and you are taxed on those profits. And you also have to pay Class 2 and Class 4 national insurance contributions. For limited companies, it comes under the corporation tax regime. So all the profits are taxed at the corporation tax rates, and then it's looking at how to extract the profits, whether that's via salary or dividends, pension contributions, or other methods. So if we look at VAT, first of all, you don't have to register to be for VAT registration unless your turnover hits 85,000 on a 12-month rolling basis. VAT is charged at 20% generally. You can voluntarily register if your turnover is below this level, and this does allow you to claim input VAT. But you do have to remember that it does add 20% to your prices, which can be detrimental if you're selling to consumers. If it's business to business, that's not such an issue because they just claim the VAT back. But if you're selling to an individual, like me as an individual, if I have my nails done, then the nail salon that's VAT registered would be 20% more expensive than the one down the road that isn't. So when we are looking at sole traders and partnerships, as I said, the profit is taxed on the personal tax returns. So if it's a partnership, then once the accounts are prepared, you file a partnership return, and then the profits are split in whatever proportions are agreed in the partnership agreement, whether that's 50-50, 40-60. And you then have to look at the different rates. So you've got your personal allowance at 12,570, so that's effectively tax-free. And then you're taxed at the basic rate of 20%, so that's going up to 50,270. And then you're onto the higher rate. There is an additional rate of 125,140, which came in this April. And there is that additional rate is 45%. You've also got to think about national insurance. So it isn't just thinking about that 20% when you're in the basic rate. You've also got your Class 2, which is back when people used to have their yellow books and they pay their £3 a week, or however much it was back then. But you've also got to factor in the Class 4 national insurance, and they are taxed at 9%. Anything above that suffers national insurance at 2%. National insurance is important, of course, because you need 35 qualifying years to be able to get your full state pension. If you're claiming child benefits, then any child carers, obviously wives generally, they would get the first 12 years of having their child as a credit without having to pay that. And you can also make a voluntary contribution. So often people will make a voluntary Class 2 contribution, because if you come to have to buy those years back, they're normally about £800 a year. So we're looking at the limited company tax then. This has just come in April. So we've now still got the 19% for profits below 50,000, but you've now got this effective marginal rate of 26.5%, which is quite a hike. And then 25% after 250,000, which is why when we're talking to clients at the moment, it's really important about talking about how to keep below the 50,000 if possible. There are things we're talking to people about pension contributions. So of course we've had that change recently where you can now pay £60,000 a year in pension contributions. and things like bringing electric cars in. Remember, dividends are not an expense. So then once you have paid or calculated the corporation tax, we've then got to look at how you get the money out. So often it's a salary dividend combination. So often we put through a salary, which traditionally tends to be up to the personal allowance level or the national insurance threshold level, and thereafter it tends to be dividend extraction. The corporation tax increase has changed things slightly in that it is going to be a case-by-case basis. If it's going to keep people below the 26.5%, it's very carefully looking at what's the most optimum salary level for them. So the important thing is salary is deductible for corporation tax purposes, dividend is not. They both need to go on the tax return. With the salary, that should be a monthly submission under RTI. And for dividends, it goes on a tax return. You now have the £1,000 allowance, which will be going down to £500 next year. And that is taxed at 8.75 in the basic rate, 33.75 in the higher rate, and 39.35 in the additional rate. So it is really important to keep accurate financial records, and of course, pre-MTD, lots of people use desktop Sage, they might have used spreadsheets and so forth. And if you're not VAT registered, you can still use spreadsheets. But obviously more and more with cloud accounting, people are using a lot of the different sort of cloud softwares. We are Xero champions on for Xero, not just Platinum, but also Champion. We're also elite for QuickBooks, and we're Sage accredited. We are not one size fits all. We look at what the clients need, and we recommend different softwares, which is why it's important to be able to understand all the different softwares and their offerings. So for example, I might talk to a client and say, you know, Free Agent is great, it comes for free with your NatWest bank account, but that doesn't work for everyone because it may not do some of the things they need, like tracking categories and things like that. And then Xero and QuickBooks, they can integrate well with some other different types of software. So we've got clients who have, for example, an EPOS till. It may be that for their particular till, either QuickBooks or Xero or Sage integrates better. We also got the different sort of OCR technologies. So Sage is really coming on with that OCR technology. So the OCR technology is really where they are, where you sort of scan things in. So you've got things like Receipt Bank, Dex, HubDoc. So HubDoc comes for free with Xero, and that's really good because it was really QuickBooks that came up with this click and go type idea initially, and then obviously the others have followed suit to be able to make sure that that technology is available, and Sage is sort of now catching up with the likes of Xero and QuickBooks. So you don't have to have that cloud-based software if you're not VAT registered, but you do at the moment. If you're VAT registered, you have to file under MTD, and it's now going to be required for a lot of unincorporated businesses for 2026. That got put back. It was about to come in this April, that we're in now, but thankfully it got put back because a lot of people just weren't ready for that. So this is the MTD roadmap. So this is really what's pushed people into the different sort of cloud-based softwares. So in April 22, then it was mandated for all VAT registered businesses to have to file under MTD, i.e. they needed some sort of cloud-based software or a bridging tool. And then we sort of move on now to 2026, where the self-employed and sole traders will be required to file under MTD, where there is property income exceeding 50,000 and or business income. And from 2027, then this is going to bring other businesses in then with profits and income above 30,000. So ultimately, they're really looking for much more regular reporting, so that they can really see how much money they should be getting, and ultimately, I'd imagine, should close their cash flow gap. So something else we get asked a lot is about allowable business expenses. So of course, they reduce the taxable profit, whether or not you're, sole trader or limited company. And the key words are wholly and exclusively for sole traders and wholly exclusively necessarily for limited companies. So the sorts of areas which people often ask about are different sort of office costs, supplies. With entertaining, so staff entertaining is allowable if you're doing an annual event, £150 per head or less. And of course, you could do 2 events in a year if you wanted to. So that's always a good one to remind clients. Mobile phones in the limited company name is an exempt benefit, so that's always good to be putting through. And then, of course, there's whether or not you have a car in the business, or whether you put through mileage, and the mileage rate is 45 pence up to 10,000 miles, 25 pence thereafter. Use of home as office is also another key area which people tend to ask about. There are statutory rates, £26 a month for more than 25 hours working from home, £18 for 10 to 25 hours, and £10 for less than that. However, if you have got a office which staff can come to, since COVID now, they're saying that people can only claim that use of home as office for their staff if they don't have an office for them to work from. So there was a relaxation of that over COVID, but they have restricted that up. You can also look at apportionment of costs, but HMRC have very much restricted up on that, and their statutory rates are such where they've done a mass calculation because they've taken account of the fact that mortgage interest and rates run 24 hours a day. You also have to be very careful not to put too much through so that you don't risk your capital gains tax exemption on the sale of your home. So costs that are generally not allowable then are entertaining clients, which is quite annoying. We do have a client who is a recruiter, and of course they have a lot of coffees in a lot of coffee shops all across London, and they're not allowed to claim this. We even wrote to HMRC to say this wasn't fair, and they said, tough, that's the rules. So that is very strictly there. Things you can give clients are if you can give them a gift with a logo on it, but you certainly can't allowably entertain them, and you can't give them food or wine. So bit sad because you can't be very generous at Christmas time. Also dual use, so that's a classic where people will say, I'm going on holiday with my family, I'm going to have a day's business meeting, can I claim some of my travel costs? And they try and come up with these different apportionment methods. No. If there's dual use, no. So if you're going to Italy for a business trip, don't be tempted to go and make that into a family holiday because it will then be disallowable. So for sole traders and partnerships, we now have to make sure that the accounting periods align with the tax rules. So there are some transitional rules in place for businesses where their year ends are different to the tax year. So I've got some clients who've got April, May year ends, because it's pretty horrific for them in the transitional year because they are going to be paying tax on 20, 21, 22 months profits. Yes, they can deduct their overlap relief where they were taxed twice originally, but as a lot of businesses are loss making in the early years, most of them haven't really got much to offset. They are saying that they're going to allow that to be paid off over a period of time, but what it does mean is that where they've added the profits together in the transitional year, which is coming up, then they're going to start falling into higher rates that they never fell into before. So that is quite an issue. So generally then, in terms of timings, your self-assessment tax returns would be due the 31st of January following the end of the tax year. So we've just finished the tax year, 5th of April. We haven't got to file those tax returns until next January. However, it's important to be able to do those nice and early in the year. And it also means that you know what your cash flow is, you know what's happening, and it gives the opportunity for tax planning. Where we've got limited companies, we often complete the personal tax returns at the same time as the limited company accounts. Something that often catches people out are the payments on account, which is pretty horrible when you first go into that regime, because it means that you're paying not only your tax for that year, but half again in January and half again in July. So, for example, if a client had just started trading, they had a tax bill of £10,000, tax and national insurance, then in January they'd have to pay £10,000, but they also have to pay £5,000 towards the next tax year and £5,000 again in July. So that can be quite horrific when that first happens in terms of cash flow. So for limited companies, you can have any year end. I always say it's good to remember it's a pregnancy term. So from the year end, you've got 9 months to file the accounts. Oddly, you've actually got 12 months to file the corporation tax return, although that's nonsense really, because you have to have calculated the corporation tax to get the figure right in the accounts. So, you know, it all tends to get done together, the accounts and tax return. And the corporation tax payment is due 9 months and 1 day after the year end. So again, the filing for 12 months is nonsense because you need to know what the tax is. If you pay yourself a dividend, of course, that would be included on your self-assessment tax return, which is due by the 31st of January following the end of the tax year. So it is really important to plan for your tax liabilities, and it's important to get your accounts done nice and early after your year end, because obviously a sudden tax bill can indeed harm your cash flow. And it's also good that you can understand your tax bill and put money away to cover it. We are slightly different in our approach in that we like to have year-end meetings for accounts and tax returns, and it enables you to fully understand your accounts and to fully discuss all aspects and any costs that you might have missed. So for research and development then, this blue sky thinking, it was something that was really promoted by the government historically. Unfortunately, it has been abused by a number of people and also some of these R&D companies that promise the world. So people were starting to say, oh, I've got a flat white coffee with oat milk and nuts. That's R&D claimable. No, there are some rules around that. It has to be advancement of scientific interest and so forth. Has to be something that hasn't been done before. So how it works is the R&D relief either reduces your taxable profits for corporation tax purposes, and thereby it reduces your overall bill, or it can provide a credit in the form of cash payment if your company is loss making. This currently provides an additional 86% deduction on qualifying costs or a 10% credit. Okay. So cars. So that is always a big question. Now, if one of the key benefits of being a sole trader or partner is, I think, is the cars. You put through all your costs, you put through the car, fuel, tyres, everything. And all they ask you to do is a private use percentage. So it has traditionally been the case that when it's come to limited companies, we say, well, I wouldn't put a car through because benefit in kind charge is going to be too high. But there are benefits of low emission or electric cars. So, for example, I've got an electric car, which I bought everyone to death about because it's really good. I charge it at work, so it's free in terms of the energy to run it. Then I can put the lease cost through the business. Usually there's a VAT block on cars, but we can actually claim back 50% of the VAT because it's leased. And the benefit in kind charge is just 2% of the list price. So just remembering with benefit in kind, then that would go on your P11D, and you have a national insurance rate to pay on, and it would also go on your self-assessment tax return as earnings. But actually, when you're looking at just 2% of the list price, that's fine. Whereas back when people were putting through big cars like Jags where the emissions were high, their benefit in kind charge would have been huge. People often ask about hybrids. Again, you just have to look at the emissions. There are, if it's less than 50 grams per kilometre, it does still fall into the electric car rules. So for corporation tax, if you buy a car, you get the 100% first year allowance, whereas other vehicles, you just have your 18% write down each year. And the other benefit is for car charges at home, they can be paid for by the company, and that's an exempt benefit, and obviously at your place of work, so that can be good. You can't claim the electric to charge it at home, so if you are thinking about getting an electric car, you need to look at how much your electric at home is costing you. I know that there are some electricity providers who have an octopus as their logo, where it's a very low rate between the hours of midnight and 4 AM, although you do need a smart meter for them to be able to monitor that. But you can claim 9p per mile, even if you've got an electric car, for your business mileage, and that effectively is to cover your the cost of your electricity at home. So if we move on. So again, a lot of people say, is it beneficial to be a limited company or a sole trader? So over the years, HMRC have very much changed the tax so that it isn't really much more beneficial to be one more than another. You'll see here that you've got the optimal rate is 60, 70, 80,000 pounds profit, where it's still beneficial to be a limited company. But I think now the thing to think about really is when you're self-employed, you are taxed on all of that profit at the 20%, 40% rate with the national insurance. With a limited company, yes, you do have to pay corporation tax at 19% or the marginal rate of 26.5%. But you can then turn on or turn off the tap for taking that money out. So more and more people are thinking about keeping money in the limited company or taking it out in the form of a pension contribution, which of course is corporation tax deductible, and thinking about other ways to use their money, such as cars and so forth. And so it is a bigger subject now, just than looking at the raw numbers. We've also got things that we can take into account, such as child benefits. If people are earning more than £50,000, then obviously that starts to get clawed back and it's gone once you're at 60,000. Whereas if you've got a husband and wife limited company, the profit in the company is irrelevant child benefit, but it's what goes on your tax return. So all for today. If you've got any questions, then please do get in touch. There is a QR code there, which should put my details straight into your phones. Here are the contact details for our 3 offices.